Rod. Okay. So welcome everyone. This is our December presentation for the Fiduciary Education Forum, and welcome. I am Todd Wohl with Braun International and Premier Estates International Real Estate. We are the hosting and sponsoring organizations that have created Fiduciary Education Forum. It's now over 3 years. So we're very proud um, of the um, of the work that we've done in bringing great presenters and valued educators to our Fiduciary Education Forum. So we're happy to have all of you. Just to remind you, this presentation will be recorded and available at the fiduciaryforum.com website probably tomorrow, as will the actual presentation that you see on your screen. For those of you, just a quick reminder. Our companies, both Braun International and Premier Estates, we appraise, broker, auction, and loan on real estate and specialty business assets and partnership interests throughout the US, Mexico, Caribbean, and England. We have approximately 4,800 agents and partners cover just about every market that you can imagine in the country, and again in Mexico, Caribbean, and England. And our clients range from individuals, major law firms, trustees, courts, wealth managers, business people, real estate investors. It's a broad mix. But I'm very pleased to have Doug Himmel, who is our guest speaker today, who's going to be talking about uh, um, existing life insurance policies and how to plan and to actually to liquidate them. I've been fortunate enough to know Doug for many, many, many years. We work together in certain business industry clients and see each other at many events. And just recently did a presentation with Doug a few weeks ago to the ABI, to the American Bankruptcy Institute, on similar topics. So I'm pleased to have Doug speak. And Doug, I will turn the floor over to you.
Thanks, Todd. Thanks everybody for joining. Again, my name is Doug Himmel. I'm one of the founders of Melville Capital. We've been in this business for over 20 years, helping different advisors from near and far deal with this topic, which is existing life insurance. And just to be clear, and I know there's probably a lot of people who approach the advisors on this presentation about new products and how to put new policies in force. We're a very big believer in life insurance. If you need it and you can afford it, it's a great asset. But when it comes to a time and a place where policies are no longer fitting people's needs or desires, this is where this topic comes in. So we don't sell product. We're not interested in talking to you guys about new long-term care or annuities or any kind of new policies. We're talking about existing policies that were put in place for a very specific reason. So with that, if Todd could move to the next screen, that'd be great. So what's a life settlement? There's been a lot of misnomers, a lot of news, mostly bad, to be honest with you. But we deal with only policies that are put in place for a reason, like I just mentioned, and we're not looking to put a policy in place for the purpose of selling it. So what's a life settlement? It's a sale of an existing policy to an institutional investor for cash up front and no more premium payments down the road. So the institution, we're talking about Blackstone, Apollo, Fortress, big private equity, big hedge funds, pension plans, overseas and domestic, that buy these policies as a long dated risk asset that they put on their books and eventually collect on the death benefit. So the sales price is obviously going to be lower than the face amount, but what we're talking about is a sales price that's typically much higher than the cash surrender value. So essentially, there's an arbitrage between what the insurance company tells you a policy is worth and what an institutional investor will pay you for that, the fair market value. So next slide, please. So where did this come from? It's been in the life settlement business has been around for about 35 years. It was started with young insureds who typically had AIDS or cancer, life expectancies that were lower. There was a lot of private investors that were buying policies of people that they knew down the street, or maybe it was a friend from college who needed some money for experimental treatment or some sort of, maybe it was a last hurrah. Over the past 20 years or so, this institutional market has evolved. We have only institutional investors looking for people who have a change of need or financial condition versus some sort of dramatic change in health. That said, obviously, we do see some policies that unfortunately, the insured has a very big change of health, but that's typically not what the marketplace bears. So next slide, please. So again, there's a lot of misnomers about the marketplace, and we hear all of them. And so we like to talk about why it makes sense to take the leap. So it's been legal for 100 years. Oliver Wendell Holmes decided in 1911 that life insurance was a capital asset and it could be transferred just like any other asset. So for advisors, obviously, it's ethical to give clients information and choices. This is another choice. If they need the policy and can afford it, they should probably keep it. But cashing it in or canceling it without running sort of process or analysis and just going, essentially giving back the policy to the insurance company for some arbitrary number, probably not a great business decision. It's approved by about 43 states, including Puerto Rico. Other couple states regulate something called viatical settlements, which is similar to a life settlement. Just it describes somebody who has a 2-year or less life expectancy, and it can be profitable. The average policy last year sold for 6.2 times the cash surrender value. So we're not talking about an incremental overage above the cash value. We're talking about sometimes an exponential difference. So clearly it depends on the age of the person and what kind of policy and so forth and so on. But last year, the average policy sold for 6 times the cash value.
Doug, let me ask you a question about that, please.
Sure.
When you talk about, for our viewers who may not be familiar with how to monetize a policy, whether it's
Sure.
after death or pre-death, when you talk about 6.2 times a multiple, the first question is, so I'm clear, so your viewers are clear. Uh, does Melville Capital actually buy the policy direct from the estate?
We do not. So we act as a fiduciary to the seller. So we get hired by people that own policies to run the process and make sure that we're turning over every potential stone, trying to find buyers that will pay the most for that particular policy at that particular time. So we do not put it on our balance sheet. We're not trying to capture some spread and sell it out the door the next day.
Understood. And because Melville's, as you said, have been in the business for 25 or so years, I would assume that you know the top players that exist out there for um, acquiring policies, correct?
Absolutely. Yeah. So because we're in the market with policies all the time, we know who's buying and who's aggressive. And yeah, we're in touch with everybody. And it's a sort of a finite business in that there's regulation around who could buy these policies. And so in our business, that's called a licensed provider. The provider is the licensed entity that buys on behalf of these institutional investors. So while we don't know what's going on behind the scenes with the investors and what they're buying, we do know who the all the providers are all the licensed entities, and we make sure that we only deal with licensed entities because the last thing I want to do is sell a policy to somebody down the street and it turns out to be the wrong person. Somebody who doesn't have, maybe has some nefarious intentions. So that's
Under
why we only deal with the institutional investors.
Got it. Okay. We'll get us zoom into that a little bit more. Okay, there you go. Next slide.
Sure. We get called in by all sorts of different advisors, from personal advisors like insurance agents and estate planning attorneys, all the way through, like Todd said earlier, restructuring and bankruptcy advisors. And we see a lot of reasons why people don't want, can't afford a policy. So changing needs like estate planning, people giving money away, maybe there's a death or divorce of a beneficiary, kids are grown up, potentially maybe they've decided that they just don't want to continue making premium payments and would rather use that money to invest or to take a trip, pay for their grandkids college, buy a vacation home. We've seen some policy related issues like cost of insurance increases because these carriers have decided that a particular book of business that's within their aggregate book of business is was underpriced perhaps, and so they raise these costs. They raise the cost of insurance, so people get a notice in the mail that says essentially, good news is that your policy is still enforced. Bad news is you owe us some more money. And then sometimes it's just an underperformance of a policy or a policy that has been underfunded because they bought it thinking it would, the cash inside the policy would grow at 6 or 8 or 10% a year, and it didn't. In the corporate space, we see key man policies and policies that were used to fund a buy-sell agreement that are no longer needed because exit planning, succession planning, retirement. Sometimes it's an M&A transaction or a private equity transaction, or we're dealing with a family-owned company that's going through a recapitalization and restructuring, and there's policies on the two brothers that started the business, and they have a lender that needed to be paid off, and a new lender that needed a lower LTV. So in that respect, it was a corporate-owned policy that no longer was financially feasible, and they would rather use the cash to fund ongoing operations versus wait for one of the founders to pass away. Next slide, please. So this is just, the demographic shift is upon us, the silver tsunami. You pick up, any newspaper or go online, you hear all sorts of talk about this silver tsunami that's coming. Next slide, please. There's, I think, the news, there used to be 10,000 people were turning 65 every day. Now it's 11,400 people turning 65 in 2025. And in 2025, there's a record amount of Americans turning 65. That's just going to grow over the next 10, 20, 30 years. What does that mean? It means that people are going to outlive their retirement. They're going to outlive their financial projections that they made, and they're going to have to turn to assets like insurance that they may not need anymore to fund retirement or to pay for ongoing expenses. Next slide, please.
Look, those are interesting stats, Doug. Um,
Yeah,
Demographics.
it's
Yeah.
it's significant. It's really significant.
hmm Okay.
So how big, statistics are big. How big is the opportunity? What I like to say to people all the time is, the life insurance companies are not so dissimilar to the casino, where the casino wins 90% of the time, the insurance company wins 90% of the time, because more than 90% of all insurance policies are lapsed before they pay a death benefit. 90. So that's a lot of policies that people are deciding they don't want, don't need, can't afford. And right now, according to recent statistics, 600 billion of policies that are in force today could qualify for a life settlement transaction. So that's a lot of policies, 250,000 combined with face amount of 110 billion are lapsed or surrendered every year. So advisors that are talking to their clients about their life insurance, their estate planning, corporate planning, exit planning. There's a lot of policies that are on the books that people are just essentially getting rid of because their short-term needs have been met and their long-term needs are that they would rather have the cash to pay that they're using to pay premiums to use for other obligations or other choices that they're making. Next slide, please.
Amazing.
Like I mentioned before, policy sellers have been, very positively impacted. Average sales price is 6.5 times the cash surrender value. That's an average of 223,000 per policy, with a total of over 500 million paid in aggregate last year, above and beyond what people would have gotten had they surrendered the policy. So again, these are big numbers. Every situation is a little bit different, but these are very tangible benefits to people who already have an asset and they're coming to a point in time where they're making a decision about what to do about it.
So let's just give our viewers, Doug, a simple example. I'll pick one out of the sky, and you can kind of work through it.
Sure.
A person has a let's call it a whole life policy. It's paid up in full. Dividends are accruing and are paying the annual premium, and it has for easy round numbers $100,000 death benefit, and I don't know, making it up, $40,000 in cash value today. Okay, so with that, if you were to be brought in, what would that policy sell for? If as a range, just to give your viewers.
Sure, and maybe it makes sense to dig a little bit deeper into the details of life insurance. So whole life, just to be very quick about it, whole life is basically like a 15-year mortgage. It's geared to accumulate a lot of cash and have a big nest egg in it. Okay, right? So a universal life policy or a variable universal life or an index universal life policy are geared more toward maximizing the death benefit, but having some cash value in it. So oftentimes we see that people think they have a universal life, but they have a whole life, or vice versa. In your example, it would depend on how old and how impaired the insured is. But I could tell you that the range would be, it could be significantly, it could vary significantly depending on the age or the condition of the person. But I do have some slides and in a couple slides with some examples of real life things that may be interesting to the audience. So maybe
Okay,
we
then
just
fair enough.
kick it a couple of slides down the road.
Okay, go
Um,
ahead.
so, from the point of view of an asset class and a residual asset class, obviously policies are taken out for specific needs, but a lot of times people don't review them. They don't reevaluate their needs. And a lot of times what we've found, especially with trust-owned policies like irrevocable life insurance trusts, we see constantly that trustees have resigned, trustees have passed away, and they haven't been updated at the carrier level, and it creates a big mess. Or people don't have an account, a bank account that pays the premiums into the policy, or there's some commingling of assets that end up, messing up the estate because people haven't kept up with the structure of the policy and why the policy was put in to begin with. So, advisors and fiduciaries would never allow a client to sell any asset other than life insurance, real estate, accounts receivable, inventory, machinery, any asset without running some sort of analysis or process, informal, formal, whatever the case may be, to figure out what the value is of that asset. But when it comes to life insurance, people literally get a piece of paper from the insurance carrier once a year and they point to it. They say, aha, AXA just told me my $1 million policy has $12,540 in it. That's what it's worth. But, without doing some sort of analysis, pricing, putting it through some sort of pricing model or sharing it with investors in the asset class, how could you possibly know what the fair value is? So, converting policies into cash obviously aligns with a fiduciary's obligation and duty to maximize value of the situations that are involved with. Next slide, please. So who qualifies? Who's eligible? So typically, it's 70 years old, change of health since the policy was issued, the life expectancy sub 15 years. Policies that are the most attractive in the market are term policies with a conversion option in it. And I want to put a fine point onto that because that's a nuance that a lot of people don't talk about, because term policies are super common in the estate planning world and definitely super common in the corporate space because it gives you maximum coverage with a minimum cost. There's no cash surrender value being built up, but 98% of term policies have what's called a conversion option that's built into it. And it's essentially a switch that you flick and you tell the carrier with literally one or two pieces of paper that need to be signed, hey, I have this term policy. I want to convert it into a whole life, universal life, variable universal life, index universal life, whatever option they have. And because it has that option to convert it from a term policy into some sort of cash value policy, that's super valuable. And so, especially in the corporate space, we see that a lot where people, an exit of an executive, an M&A transaction, there's policies that are on the books, convert it, sell it, bring back more money to the situation. Could be a second bite of the apple for a seller of a business. It could be the money that is used to fund ongoing operations. So the difference quickly between a VUL, an IUL, and a UL, a universal life policy, whatever money you put in that goes into the cash account, that's in the main account that the insurance company runs. If you do an IUL, an index universal life, or a VUL, a variable universal life, there's some sort of stock market performance that is tied to that policy, and the growth of the cash value is based on some sort of market performance. And so that's the difference between those three policies. Next slide, please. So I won't go into too much detail about OBBVA because I think it's super nuanced, but essentially what we found is that this is changing why clients may hold policies to begin with. And so settlements is a private market liquidity mechanism that could be used to strategically realign people's needs and desires, especially as it relates to estate and tax planning, and specifically as it relates to gifting and charitable trusts. Next slide. So what's the process? It's like selling any other asset, but a little bit different. So we get an application, a HIPAA release. We gather people's medical records and we use those medical records to underwrite the specific life expectancy of that insured. So that has to do with age, gender, financial condition, underlying health conditions. There's a third party underwriters that specialize in life expectancy underwriting. They take those medical records and they put it through their process and they come up with a prediction of approximately how long that person will live. We get involved to the extent of getting in touch with the insurance company, gathering all the different information we need about the policy, including what's called an in-force illustration, which is essentially a snapshot of how that policy is going to perform over time. And then with that policy information and with the insured's life expectancy information, we send it out to the market. And just to backtrack a touch about the insured, we do not require that they go to a specific doctor or even their own doctor. No one's going to come visit them to gather blood or urine or a hair sample. It's specifically gathering medical records and using those existing records to underwrite their health. Next slide, please. So this goes more into detail about the process. We like I mentioned, we take the policy information and the insurance information, send it to the market, negotiate and obtain bids, tell you along the way where we are with those bids. Once the offer is accepted and we've come to terms, we get contracts. Contracts need to get signed. Any sort of contingencies and cleanup items get dealt with before the policy goes to the carrier for the change of owner and the change of beneficiary designations. Money gets put into a third-party escrow account, just like you see in a real estate transaction. So once the new owner is designated and the owner and the beneficiary is designated, the escrow company gets notification of that and releases the money to the client. Next
So,
slide,
Doug,
please.
let me ask you a question on this.
Sure.
So, on this page, my assumption is that Melville Capital is in the middle of all of this process, correct?
We run the whole thing. So we like to say that we obviously know the market, but we run the process from start to finish, and we deliver obviously the client, the insured, and the owner, if those are different people. Sometimes it's a trustee. They have to obviously sign documents, but we run the whole process from start to finish.
So, for our viewers, not to simplify what Doug's company does at Melville Capital or what we do at our companies, in the end, it's Doug's company is a broker to establish and find the highest and best price for the cash value for the policy, whatever type of policy it is, and subsequently, by doing that, the as a fiduciary representing people, obtaining the highest and best price, and of course that's what the clients want because they want to get the best price for their clients, whoever that might very well be, or the estate themselves, right? Fair enough.
That's 100% correct.
Okay.
So, where to look? I mentioned this a little bit, but succession planning, retirement, bankruptcy, death or divorce of a beneficiary, kids are out of college. Again, I mentioned the term policies. That's a really big opportunity, we think. And so we harp on that quite a bit because, it's something that because it doesn't have cash in it, it's particularly interesting because people are about to get rid of it for zero because it doesn't have cash in it, and we can convert it and sell it. It's really completely found money at that point. Next slide,
So
please.
hold on, let me
Go
ask
ahead.
you on this case. So, um, how does, I guess this is an interesting question. Hopefully you have an answer. Um, a fiduciary that's taking over an estate, a trustee, it's a third party appointed to manage the assets of an estate. How would that person, that company, entity, what have you, find out if an individual has life insurance policy? How do they do that? Is there some sort of central database?
You know what? I wish there was.
Mhm.
But as it relates to like the corporate space, it's usually listed on, in the
Right.
books. We do find that sometimes people forget they had a policy. We just did a case recently where the trustee was completely asleep at the switch and realized that they had a policy and ended up I'm not really sure how it came back on his radar, but we ended up selling it, and they were super happy to be done with this policy and not continue paying on it. So there's not a central database, and obviously we rely on advisors, whether that's CPAs and estate planning attorneys or otherwise, to bring us in and say, hey, we have this opportunity, and we're coming to this decision tree about what we're going to do next.
Would you say, let's say, I mean, I'm just examples for our viewers here. Let's say there's an individual has a whole policy, he's deceased. So there's no records in the last 3, 4 years, the statements, bank statements that he's been paying on this policy, right? Um, so there's no financial record of payments, right? They don't find when they hire us to sell the house, right? Go through the house and you've got all this contents of files and documents and so on, and they don't come across an actual policy itself. Um, how would that individual find out if there is a policy in force? Is there a way? Um, any or at least any helpful hints, tips for our viewers?
Finding the actual policy, like a physical policy,
Well, not the
yeah,
physical policy. Let's say that's long
whether they
gone.
have
That's
one or not.
yeah, right. That they just have a policy that is in force, but they can't find the physical policy. How would they become a sleuth to find out if there's any insurance in force?
Well, if I guess if you knew who the premiums were made to in terms of which carrier, you could certainly, go to a carrier and tell them a social security number or tax ID number and uncover it that way. But yeah, you would. There's unfortunately there should be, but there's not a central database that you can type in a social security number, tax ID, and there's a list of all the different assets that are associated with that from an insurance perspective. I mean, that would probably be a really good business
Yeah,
to establish, but you would need, I guess, the buy-in from every single insurance carrier to give you all their information, and I'm not sure that
they're not going to do
I'm
that.
not sure that that's
It
on
would
in
have
the
to be on the insurer, insuree, whoever it is, the person who owns the policy. They'd have to subscribe
yeah,
to some sort of database, right?
yeah,
And
I would think
right.
so.
So,
Yeah,
so I mean, just again, I'm just thinking through this because I can imagine how many people don't remember what kind of policies they have. It's like finding the title to their car. Geez,
totally.
there's a car somewhere in some building and they can't find the title and nobody knows anything. So, would it be best to which they could find would be the bank records, I would assume, right? So
Yeah,
if there were bank records that went back 15, 20 years, statements, and be able to research that the person was paying to the Guardian Life Insurance Company 12 years ago was the last time it was paid. All of a sudden they see a check record paid to Guardian, right? That'd probably be the only way. Is that a fair
yeah,
assumption, Doug?
I would think so. Yeah.
Yeah. Okay. Okay. Fair
I
enough.
mean, listen, typically, a lot of times people, they buy a policy, there's an expression in our business that life insurance doesn't get bought, it gets sold. So people don't wake up one day and they're like, oh, all gung ho about getting a policy and running through, the process of putting one in force. They get sold a policy because, some agent calls them 1,200 times and says, hey, you need coverage, you need coverage. And
Right.
they finally relent and say, okay, I'll do it. And then they put it on their shelf or they put it in a safety deposit box or sometimes they just
Stick
throw
it
it
in the
away.
drawer.
Yeah, a drawer, throw it away, and they forget about it and don't remember what kind of policy it was or even how much it costs. And they get reminded, maybe once a year when they get their statement or they get their invoice.
Right.
So
Wow.
yeah, it's incredible. So, go through a couple examples, things that I think are really interesting. So this was a trust-owned policy. The insured had an interesting type of cancer, and so his life expectancy was between 30 and 180 months. So we had like five different underwriters that took a look at this, and that was the range. So this is a really interesting example of dealing with a broker who knows how to put this to navigate the waters and to send this into the market the right way. And so because of that huge variation of life expectancy, you could imagine that a company that thinks he has 3 years left to live is going to pay a lot more than someone who thinks he has 15 years left to live. And so our job, again, as a fiduciary, is to run that process the right way and make sure that we're maximizing the value. So in that case, The trustee, prior to us getting involved, actually let two $10 million policies lapse while her original settlement broker, who didn't do a good job, was marketing the policies. We got involved from a remarketing standpoint, and we're able to get almost $9 million versus essentially zero in cash surrender value. Excuse me. Next slide, please.
That's interesting. Okay, thank you. Hold on.
So here's a key man policy that really a really good example of what we discussed earlier, which was term policies that can be converted. And so here is a $50 million term policy. The guy was in his mid 70s. The policy was about to lapse. And it was on the founder of a well-known company here in Southern California. There was a private equity transaction. Senior secured lender had a loan on the policy. Pardon me, a loan to the company. They had a collateral assignment on the policy, and they determined that they were not going to continue making premium payments anymore because they already had enough exposure to this situation that was going down the tubes. So we got involved. We realized it was a term policy that could be converted into universal life, got them to pay it current, converted the policy, and got them 2.7 million, and made them whole actually on their investment in this company that was going through a bankruptcy.
Okay.
Next slide. So this is another example of a corporate-owned policy. There was two insureds, 8 million in total coverage. New York City Diamond, multi-generational family business. The insureds, the owners of the company, the policies were on the two owners, a husband and wife. And they needed money to fund their ongoing operations, and they were going to lapse the policies here too. And based on the type of policy, the insureds and their health records, we got them $1.3 million. And there were other policies, again, in this situation that were surrendered a year earlier because they didn't know about this option to the secondary market option.
So, Doug, let's go back to another example. These are all great case studies. Thank you. Let's. I'm making this up, or I mean, somebody's got kind of going back to what I used before, a 3-year whole policy. Excuse me, a whole policy that is fully paid up. Um, let's say the value is $3 million, right? Um, Try to finish the problem with what the solution would be and what you think. Let's say the person is, I mean, I don't know, 73 years old, and they're not doing well, and maybe their expected life, expectancy is another 3 years. So you've got a $3 million policy, and they decide, and it's paid up, mind you, and they decide they want to cash out now for whatever reason. How would you be involved? What would you do? Kind of give our viewers something to think about here.
Yeah, I mean, we would certainly. It sounds like if that type of policy, that type of situation is certainly one that would attract a lot of attention in the market for various reasons. 3 million in coverage is a big number, but it's not huge. So there, every buyer would be interested in that sort of size. 3-year life expectancy, again, that's the short life expectancy. So you'd see very big numbers on a situation like that. So we would get involved. We would run an analysis. We would make sure that we had all the medical records. We price it internally, make sure that we understood how much this policy we thought it would sell for, communicate that with whoever was involved from the advisor side. We get an application, get all the medical records, and make sure we have a really good current set of records. And then we would get multiple life expectancy reports to make sure that we were taking this to the market the right way and as aggressively as possible. And then we would send it out to the whole market and run our traditional process an auction and make sure that everybody who could see it did see it.
So to that point, tell our viewers what is kind of a standard from once you are decided that you're willing to take on the actual sale, right? What would you say is a standard timeline
Great
for
question.
the sale?
Great question. And so um, I would say the standard is about 60 to 70 days. But we've done it faster and some have dragged out longer. So the two biggest things that drive that timeline, I should say, is A, how quickly can we get medical records? Are there five
Mhm.
different medical providers and we have to send a fax and call them and make sure they received it and then wait 2 weeks for a copy service to be involved? Or is there a portal that I can log on to with you, download all the medical records today, and you can change the password after we, finish our call, and then
Mm,
we're off and running. So I mean that's a really big um, like discrepancy in timing and also in aggravation and in
right.
everything else. Calling them, like I don't know if anyone's dealt with getting their medical records, but it's not easy. And they're not, and these doctors' offices are traditionally not super helpful because this is not a profit center for them, and they want their nurses and their billing people doing things that are a lot different than answering the phone, and sending out medical records. So that's a very big component of the timing. So we always ask, hey, do you have a portal? And then the second part is, where the timing can really be vastly different is on in dealing with the insurance carrier themselves. And some insurance carriers are easier to deal with than others. Some take 3 or 5 business days to do the change of beneficiary and ownership designation. Other take 2 to 4 weeks. So those are the two parts of the equation that really determine how quickly this is going to go and or not. The actual marketing of the policy once we're in the marketplace, we typically start getting bids within a week or 10 days, and then the process is typically lasts 2 weeks or so. And then we go to closing, getting the paperwork signed and doing all that stuff. So yeah, I would say the average is probably 60, 70 days, and maybe outliers are 90 to 120 days.
It sounds very similar to us selling real estate
Yeah,
or yeah,
it's an asset
understood.
sale.
Yeah, it's an
So
asset sale, right.
and so every asset sale has its own different
That have nuances, yeah.
yeah, exactly. So
And
go
and then
ahead.
how would a individual get a hold of you and you have like a cheat sheet. You said, okay, here's what we're going to need to underwrite this and see if it's viable. And um, you would give what we call in our business a broker's opinion of value, kind of an estimate. Do you do that? How does that work?
Yeah, for sure we do. So at the outset of every case, we obviously have a conversation about health, general health of somebody, and we try to get an in-force illustration, which is again a snapshot of the policy going forward. How much does it cost from today going forward to keep the policy in force and run properly? And um, and so at the outset of every case, we run it through our own internal pricing model and let people know, hey, based on what we know about their health, here's a range, right? We think it's going to price between, 250,000 and 350,000 based on what we know about the health and about the policy today. Something changes if we get medical records that dictate that they're maybe a little bit healthier than we discussed, or maybe a little bit less healthy than we discussed, that range will open up a little bit. But we always want to get on the same page with people up front to make sure that we're not all, collectively investing in this process, time, energy, hard and soft costs for the next 2 or 3 or 4 months to come to an outcome that no one is, in favor of. So we always have those discussions up front and do pricing up front to make sure that people understand, generally speaking, based on 20 years of this business, what we think this is going to sell for.
Right. That, as I like to say every day in our business, that crystal ball opinion, right?
Exactly.
So here's case
Exactly.
study number 4. You want to walk through that for our viewers?
Sure. So out of court restructuring, was $2.3 million policy with a little bit of cash in it. They were going to surrender it. This was upstate New York manufacturer nearing bankruptcy, and we sold this policy, and they used the money to fund ongoing operations. And they're super healthy now and doing $7 million in EBITDA. And this actually was a turnaround management association,
Wow.
small company turnaround of the year. So I like to say that we are involved in some, it's not, it's like at the core of our business, we like to help people, right? And so to save a business by, bringing to their attention something that they were going to lapse for 25 grand and they ended up getting 280,000 and it put them over, sort of got them over that proverbial hump and help, fund operations for a little while and get them back to, super profitability today. So, I look at that and I say, we didn't save anybody's jobs, but we certainly were, helpful in saving a company that was also multi-generational.
Okay. Case study number 5.
Um, so again, it was just an M&A transaction. The insured was the founder and CEO. Company was going through an EBITDA decline. And the cash infusion was, critical to keep the company the lights on until the sale was complete. So this was a situation where the CEO, I believe, actually took some of this was a corporate-owned policy, but they had other policies that they took after the sale and were able to monetize those as well. And it's life insurance is an asset of the estate, it's an asset of the company. It should be dealt with and treated as an asset, not just an expense. And that's something that we talk about consistently with advisors, because a lot of people are just conditioned to look at it as an expense. It's not worth anything unless somebody passes away. But like other assets of the business, it should be treated as such. And sometimes you can move those pieces around the board strategically to come up with a different outcome.
Let me ask you a question. Just another example. Let's say there's a policy in force, and the party is that the policy is based on is not doing well, um, and the the estate is still paying up, yearly premiums, and the estate is cash poor, right? Maybe asset rich, but let's say cash poor, or maybe just purely poor, completely, no assets. Is there any role that you would come in that you think you would be of value in that situation?
Yeah, so there's something called premium finance, which is essentially a mortgage on a insurance policy. So there's lenders that will make loans to policy owners to fund premiums. Oftentimes they have, especially if it's an asset-rich company, like they have real estate or some other tangible assets, you could pledge those and get a loan against it to keep the policy in force. Especially if that person is not doing well. The last thing you want to do is have a policy lapse for lack of payment. So yeah, there's premium finance lenders that step in for different reasons. There's a whole market of these premium finance lenders that are people, in today's world, they're buying these policies that are based on stock market performance and trying to capture a spread. So they're putting a new policy in force. They're borrowing at 6%, let's say, and they're hoping to get 8 or 10% cash value growth in the policy. So they're capturing that delta. It's a little bit of a sidebar to this conversation, but yeah, there's plenty of lenders into policies depending on the situation, especially if there's assets. So you asked me
Interesting.
earlier how people get in touch with me. There's all my contact information. We have a website. We actually just redesigned it. I think it's going live today or tomorrow. And then we have all sorts of marketing materials, 1 page, 2 page, that cheat sheets, like you mentioned earlier, where people can remember what to look for and what makes sense to send to us. But at the end of the day, if people have questions, if they have any policies that they think or situations that they think may fit into this dynamic, this category, this conversation, call us. Let us tell you that this is not going to work versus just assume that it's not going to work.
So, just for clarity purposes, that initial heavy lift of analysis and opinion, that's no charge. Is that right, Doug? Or is there a fee
That's
for that?
no charge. So we don't charge any application fees, any administration costs, any appraisal fees or anything. We get paid at the conclusion of a transaction, a success fee, um, based on um, based on the price of the sales price of the policy. So there's no fees up front or along the way. If everybody walks away happy, then we get a success fee. So
Okay,
it's
so
sort
it's
of like a lawyer working on contingency, if you
so
will.
understood. Same with us. So, is there a range in what a fee charge is? Is it a percentage? Is it a dollar amount? Is there anything you want to give the audience ideas as for what how that's calculated, or is that,
Yeah, it's it's a it ranges, so it depends on the situation, but in general, it's much like an insurance, I mean, a real estate transaction where
okay,
the standard and typical 3 to 6% kind of thing.
okay,
So that would be what I would leave people with. There's some different ways to calculate it, but that's the simplest way to think about it.
understood. Okay. Do any of our viewers have any questions for Doug? If you want to just unmute yourself and ask the question directly, you may do so. Um, um, or, of course, you can email Doug directly as you see on the screen, at his website. The company is Melville Capital. The website is melvillecapital.com. Um, so if there aren't any other questions,
Todd, I have a quick question.
yes, please go ahead,
Can we
sir.
talk about tax consequences of the sale of it?
That's a good
Mhm.
question, Brian. Thank you.
Happy to talk about that. So, a sale of an insurance policy is typically a long-term capital gain. So the difference between the underlying um, how much you've put into it, what your basis is, and the sales price, that delta between the sales price and the basis is considered a long-term capital gain. If the policy has cash value in excess of your basis, the delta between your basis and the current cash value, that's considered ordinary income, but we very rarely see that situation pop up. But in general, it's really a calculation between sales. Take your sales price, you subtract your basis. That's your capital gain. What you get taxed as a capital gain.
Great question. Thank you, Brian.
Thank you for
Uh,
that question.
great
Good answer.
question.
Thank you.
Um, Doug, I want to say thank you for our audience. Our next Fiduciary Education Forum presentation is January 6, 2026, noon to 1 p.m. And the topic will be we've got some great speakers. It's going to be on environmentally hazard or environmentally damaged or impacted real estate, real property. What do you do with it? How do you handle it? How do you sell it? How is it a liability? Is it a cost for the client? Is it how do you handle the ownership and or sale of environmentally challenged, damaged, impacted real property. Other than that, Doug, thank you very much for being on. We sure appreciate it. And we hope that our viewers contact you at melvillecapital.com. That's D Himmel at melvillecapital.com. Again, this presentation will be at fiduciaryforum.com, meaning the entire video presentation will be up on our library, as well as the PowerPoint presentation will be there for you as well. So you can go back and view this at any time. And we sure hope you all have a happy holidays. And thank you for participating. And Doug, thank you again.
Thank you for
And
the opportunity, and thanks everybody for joining in.
it's our pleasure. So thank you for being part of this. And we're going to sign off and happy holidays to everybody.
Happy
Thank you
holidays.
again.
All right,
Thank
Thank
you.
take care.
you.
Thank you. Thank you very much.